Got an interview coming up and you need to get your head around IFRS 16 like yesterday? You're in the right place. We're going to slice through all the jargon and focus on exactly what you need to say to sound like a pro. Let's dive in.
First things first. To really get IFRS 16, you have to understand the problem it was designed to fix. And it all started with things that were, well, kind of being hidden in plain sight. I mean, just think about it for a second. Companies lease everything. Offices, cars, huge pieces of equipment. But under the old rules, these massive financial commitments, these promises to pay, often didn't even show up on the balance sheet. This made it incredibly hard for anyone, investors, analysts, to see how much a company truly owed.
And this right here shows you the before and after in a nutshell. Under the old way, IAS 17, these things called operating leases were basically invisible on the balance sheet. Poof, gone. But IFRS 16 flipped the script completely, saying, nope, pretty much all of those leases now have to come onto the balance sheet. It was a huge leap forward for transparency.
All right, so what's the single most important change? The one thing you absolutely have to mention in an interview? Let's get right to the core of it.
This is it. If you only remember one thing from this whole explainer, make it this. IFRS 16 got rid of that old, confusing split between operating and finance leases for the person or company leasing the item, the lessee. It replaced it with one single unified way of doing things. So with this new model, the company now recognizes what's called a right-of-use asset. Now, this isn't the physical asset itself. It's the right to use that office building or that fleet of cars for the entire length of the lease. It's an asset you control.
And you know how accounting works, right? For every asset, you've got to have something on the other side to balance it out. And that's the lease liability. It's pretty straightforward. It's the company's legal obligation to make all those future lease payments they've signed up for.
So why do we care? What's the big deal? Well, two huge reasons. First, it gives us a much clearer picture of a company's real debts, no more hidden obligations. And second, it levels the playing field. Now you can actually compare two companies fairly, even if one company leases all its buildings and the other one buys them outright.
Okay, so we know what to do once we have a lease. But how do we know if a contract even is a lease in the first place? Thankfully, IFRS 16 gives us a pretty clear roadmap for this. It all comes down to this simple but really powerful three-question test. You just look at the contract and ask, 1, is there a specific identified asset? You can't just say a car, it has to be that car. 2, does your company, the customer, get to control how that asset is used? And 3, do you get basically all of the economic juice from using it? If you can say yes to these 3, congratulations, you've got yourself a lease.
Now, the standard isn't totally heartless. It gives us a couple of practical outs. You don't have to go through all this for every single little thing. There are two main exemptions. Short-term leases, so anything 12 months or less, and leases for low-value assets. And here's a great little tip for your interview. The standard never actually puts a dollar amount on what low value means. Okay, we've nailed the what and the why. Now for the fun part, the how. What do the journal entries actually look like? This is where the rubber meets the road. This table basically tells the whole story. Right at the beginning, you debit your right-of-use asset and credit the lease liability. Then, every time you make a payment, it gets split. Part of it is interest, that's your finance cost. The other part is principal, which chips away at that big lease liability. And finally, just like any other asset you own, you depreciate that right-of-use asset over the life of the lease. You know, if all those debits and credits feel a little abstract, here's a fantastic way to think about it. It works just like a mortgage. Every payment you make has two parts. The interest, which hits your profit and loss statement, and the principal, which pays down your debt. And this is a really crucial point for analysis. Since interest is always highest at the start, this new model front-loads the expenses compared to the old, simple straight-line rent expense. All right, you've got the core concepts down. Now let's put it all together. We're going to run through the most common questions you'll get on IFRS 16 so you can walk in there totally prepared. Okay, first up, they might ask about the objective. The key words you want to use here are that the goal is to faithfully represent lease transactions and give a more complete picture of a company's finances. It's all about honest and complete reporting.
This one is all about the why. Your answer needs to zero in on that big problem we talked about, off-balance sheet financing. Just explain that under the old rules, investors couldn't see the true level of a company's debt and risk, and IFRS 16 fixed that.
This is a direct test of the main concept. You just need to say two things, a right-of-use asset and the corresponding lease liability. If you can name those two, you've shown you understand the absolute core of the standard. Here, They're checking if you know the practical side of things. So what do? You bring up that 3-question test. Is there an identified asset? Does the customer have control? And do they get the economic benefits? That's your home run answer. This question shows they're interested in the real-world application, so you just need to mention those 2 key exemptions we talked about: short-term leases, which are 12 months or less, and leases of low-value assets. It shows you know it's not just about theory.
All right, this one's a little more technical, but you've got this. The magic phrase you want to use is the present value of all future lease payments. Saying that shows you've got a much deeper understanding of how the numbers are actually calculated.
And as we wrap this up, just remember this. Your interviewer doesn't want you to just recite definitions from a textbook. They want to see that you get the logic, the why behind it all. Think about the story that IFRS 16 tells about a company's finances. If you can do that, you'll be golden. Good luck.